Because of the growth of the NASDAQ in the market these last couple of years, JEPQ has become my largest position in my portfolio. And I came across this article here on Seeking Alpha from John Bowman titled JEPQ and its place in an income portfolio. I am so excited to share that today's video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to track my dividend income and analyze my portfolio. Whether you're a new or existing Snowball Analytics user, use promo code DGI to get the very best pricing. So now that I'm living off my portfolio and I'm no longer working a day job, if I could only own like 3 or 4 different investments, JEPQ would absolutely be on that list. Like if I had to think of, force myself into a hypothetical situation where I could only own 3 investments, I'd pick SHD, DGRO, and JEPQ. And I would weight them based off of the income that I had and the expenses that I was trying to cover with the income. And so thankfully we don't live in a hypothetical fairy tale land, but we live in the real world, and we don't just have to have 2 or 3, 4 different investments. But I think if you're planning on living off of your portfolio in the near term, I think JEPQ should really be on your radar, because I would not be able to retire the way that I did if it wasn't for JEPQ. Now, obviously, I could go and I could invest more into sin stocks. I could invest into BDCs, MLPs, and reach for yield. But in my opinion, that's quite a bit riskier than investing into an ETF like JEPQ. And it really comes down to owning, having the single stock risk. I would much prefer to have the yield in an investment like JEPQ that tracks a NASDAQ that has a little bit of some active components to it, which we'll get to in this article. But I just want to preface that I am a huge fan of JEPQ. And if you're either in retirement or nearing retirement, JEPQ should be on your radar. Now that's obviously if you're looking for income and you want to boost your yield. So with that, let's take a look at this article. This is going to be, I think, the second article that I've reviewed from John Bowman. I think the last article that I reviewed here a couple of weeks ago, I really enjoyed it. And so let's take a look at the article. So in the summary here, he has that the JP Morgan NASDAQ Equity Premium Income ETF offers high income by buying NASDAQ 100 components and equity-linked notes, outperforming many high yield assets. Now, let me explain this very briefly because this can confuse a lot of you. JEPQ doesn't own every single stock in the NASDAQ. This is where the active management comes in. They only own a portion of the NASDAQ, and they hand select the holdings based off of their, the way that they're going to screen. I think the way that they do it, this is unconfirmed, but the way that I believe that they do it is more on a momentum basis, what the stocks are going to do or what they are perceived to do over the next 6 to 12 months. That's kind of my assumption. So that's important to understand. They don't invest, when you invest in a JEPQ, you don't get every company in the NASDAQ. So that's the first thing. The second part here is equity-linked notes. These are unique to JEPI, so JEPQ, and a few other ETFs offer these equity-linked notes. A lot of them are very they're not very understood here on the internet, and I am guilty of this as well because there's not a lot of information out there on their ELN strategy, and that is kind of their secret sauce, okay, and their unique piece to this ETF. Now, I was watching an interview of Hamilton Reiner, the fund manager of JEPQ, and it is, I just want to throw this out there because this is a big part of what this ETF is. The big advantage of ELNs is the way that they're set up and how they're taxed. Because JEPQ uses ELNs, there's no return of capital. And so the tax structure changes to ordinary income. So you're not having a return of capital or return of principal, but you're having, just a ordinary income, right? So that's a big reason why they use ELNs, is so they're not doing return of capital, but rather they're structuring the taxes as ordinary income. Now, if you don't understand that, I hope that makes sense. But if you're unfamiliar with that, go and research and understand the differences of how your income, your dividends, your distributions are taxed, because in my opinion, that is a pretty big benefit, because at tax time, there's no surprises. Okay, so I know that was a lot of information, pretty technical if you don't understand it, but that's probably one of the most important things that you understand, and I wanted to make sure that everyone understands that before I finish going through the article. So moving on with the summary, JEPQ is tech heavy and volatile, making it suitable for aggressive income portfolios, but not for conservative fixed income portfolios. The fund has impressed with its returns against other high yield assets, including MLPs, REITs, and junk bonds. This article covers JEPQ and also its potential complementary pairings in an aggressive income portfolio. So when it comes to aggressive and conservative, I want to say that it is in the eye of the beholder. It really depends on how you personally classify yourself, because I would classify myself as conservative, but I invest in a JEPQ. So I consider myself conservative as a conservative investor, but it's more of an aggressive conservative. So I would not get too nitty gritty with the naming convention of conservative versus aggressive when it comes to this. Just understand where you kind of fit into there and make your own assumption. So the introduction of the article is that the JP Morgan Nasdaq Equity Premium Income ETF, JEPQ, has become a crowd favorite among income investors since its launch in 2022 and has both a positive price and total return since then. And the question I have and want to answer in this article for myself and others is, where does JEPQ fit into my income portfolio? So the overview of JEPQ is, in a nutshell, the fund works like this. What it does is that the fund buys an individual component of the NASDAQ 100. So like we said, it doesn't own all 100, just parts of it. And then the fund will buy an ELN, an equity-linked note that simulates a P&L of a covered call on the NASDAQ 100. In JEPQ's case, these ELNs are bespoke products made specifically for the fund and serviced in-house at JP Morgan. Okay, and that's why it's a little bit ambiguous. There's not a lot of clarity and information on these ELNs, and that has been a big drawback to this ETF, or criticism, because of the uncertainty, because it's not very clear how these ELNs are structured. But they are bespoke, and they're only for JP Morgan and other firms that can access them, and they're made for JP Morgan, right? So a small little firm, boutique firm, cannot go and, like a Neos, right, for example, they're not going to be able to access this vehicle, right? This product, right? This product. And so it's important to understand what you're getting here. And in my opinion, the ELNs, I went from being skeptical to seeing that this is kind of like their advantage, right? Like one of the main reasons why I like the ETF is because of the ELNs. And on the channel here, I will talk more about this. I'm actually considering adding another covered call ETF. I've actually talked about it in this Thursday series that I have here on the channel, but I'll talk about it more in the future. But I am actually a huge fan of ELNs and how they're structured now that I know more about them. So the fund collects income from the ELN and distributes to shareholders, but most importantly, the income that it distributes, as I mentioned, is listed or classified as ordinary income and not return of capital. So very, very important. So this strategy has worked well so far, with JP Morgan's distributions being higher than that of several other high yielding assets like MLPs, high yield junk bonds, and US REITs. As one can imagine, with the infamously tech heavy NASDAQ 100 index, JEPQ's holdings are also very tech heavy, about 40%. Yeah, the NASDAQ is about 50% tech. If you look at it, like, I think if I'm not mistaken, PepsiCo is in the NASDAQ, right? So it's not just tech, but it is 50% tech, right? So you would assume an index that tracks the NASDAQ 100 is going to be tech heavy. And so that's where it comes into the conservative versus aggressive. If you're a conservative investor, do you really want all that tech exposure? Probably not by definition of conservative and aggressive, but I'll let you let you decide that. So predictably, its top 10 include mostly tech names like Nvidia, Apple, and Microsoft. The top 10 encompass 45% of the fund's holdings. Here's the list outright, and I highlighted NELN. Note that the identifier tells us that JP Morgan had this product custom made for JEPQ. I believe this happens in-house with another JP Morgan department. So there's little counterparty risk associated with the ELNs that isn't shared as provider risk with the fund itself. If JP Morgan goes under, it all goes under. This is an advantage of large ETF providers like JP Morgan, where they can service their funds in-house and provide bespoke solutions like these ELNs. Yeah, so he doesn't mention this in the article, but there's also some other rules that they follow where they're not going to have more than 15 to 20% of the NAV, the fund, in ELNs. And they actually target, this was based off of an interview with Hamilton Reiner, the fund manager of JEPQ, that they actually target around a 15% of the fund. And another additional, way that they balance out the risk is they don't get the ELNs from one single issuer, but rather they have a cap of 4%. I think 5% is regulatory, and then they, from what I recall from the interview, but 4% is what they target. So they don't have more than 4% of a single ELN, equity linked note, from a single issuer. So they spread out the risk in that way, where they spread it out by issuer. They spread it out by the amount of the NAV, the fund, right, the net asset value of the fund, and they also target very short-term durations with an average around 2 to 3 weeks, with the longest being around 4 weeks. Okay, so all of that, if that's word salad and doesn't make sense, the summary there, to dumb it down for myself, to dumb it down for me too, is that the risk is observed by the fund managers at JP Morgan. They understand there is risk with every investment, and they're spreading out that risk in multiple ways. And I personally am a fan of that, especially as someone who holds a large percentage of his net worth in this investment. It is very comforting to me. And that's why I said at the beginning, I would much prefer to hold JEPQ than a sin stock that has, geopolitical issues or risks, or, government issues like for the government trying to overregulation, or an MLP, or a BDC. The single stock risk, you don't have that with JEPQ. Okay, so I'm just trying to paint the picture of how I view this as someone who relies on the income, and as someone who wants to sleep well at night, how I view this and how I compare this to other assets that have maybe a higher yield, like a sin stock, a REIT, an MLP, etc. So JEPQ currently holds 10 ELNs on their website. You can track the daily delta gamma swings, which is the only way to really tell anything about these products. They're fairly opaque otherwise, which is JEPQ's largest detractor. I don't know if I prefer them to use options over an ELN, but I would like to be able to see more information about these products so I could model them easier. Yeah, well, another advantage of the ELNs is you're not going to have the option, with a regular or traditional covered call in a bull market, you can have your investment called away or assigned, right? With an ELN, you're not going to have those capital gains where the stock is called away, right? So there are some fundamental advantages with ELNs when looking at this from a tax side, when looking at this also from, just how the fund is how it's set up overall compared to if you were to just do this yourself in your brokerage, or if you to have other options-based ETF do it for you that doesn't use an ELN strategy, which is the case with most other option-based ETFs. It's odd to me that some ELNs have a positive delta when I believe that they were all short the NASDAQ. Once this is likely explainable by something opaque to me that the fund managers are able to see, but it is worth noting. JEPQ's place in a portfolio. So first, we have to acknowledge that the fund can be volatile and has little place in a conservative income portfolio. It is not a replacement for fixed income products with far less downside risk and little downside risk if you hold individual bonds to maturity. This is absolutely true because in a bear market, you could see JEPQ drop 20%. If the NASDAQ dropped 30%, you could assume that JEPQ will drop around 20% or even a little bit more. But the difference is you're still going to get that monthly premium. And in this case, because it's based off of volatility, right, your income could actually go up. So if you're looking to sell a portion of your portfolio in retirement, JEPQ is not the right option for you, especially in a bear market. Right? You're going to want to sit with, fixed income options like bonds or high yield savings accounts, stuff like that. But if you don't need to touch the principal, then whether you're a conservative or an aggressive investor, in my opinion, it's a wash. It doesn't really matter as much because you're focused on the income and you're not looking to sell a percentage of your portfolio. Does that make sense? So it's important that you understand that. And so that's what I was mentioning. Whether you're conservative in nature or, aggressive in terms of how you're looking at this, there are pros and cons to this. So it really just depends on who you are and what place this fits, how this fits into your strategy and your portfolio. JEPQ has had drawdowns in the past. In fact, they were worse than the S&P 500 in the same time frame, but better than the NASDAQ. And so he has the returns here of the NASDAQ versus JEPQ during like 2022, for example. And so the way that you want to understand this, I recall this from the interview with Hamilton Reiner, was you could assume a beta, the beta of 1 for the NASDAQ, and you could assume about 0.75 with JEPQ. So you're not going to get as much, volatility with JEPQ as you would with QQQ. And especially because you're getting the income. When looking at the total returns, your beta is actually lower with JEPQ. So, but as you see here, even though it's better than the NASDAQ, it's still more volatile than the S&P 500, at least it has been historically. So that is a very, very good point. So when you're comparing apples to apples, you want to make sure that you're comparing them to the right metric that you're really interested in. So JEPQ's standard deviation is a little over 30% less than the NASDAQ 100's from its 21% to JEPQ's 15%. Based on data since JEPQ's inception, we can see how JEPQ moves with the NDX and its high correlation to equities clearly in the chart below. So it is very, very much an equity focus. Like that's what I really like about JEPQ is you're getting a lot of equity exposure with the option income premium on top of it. And that's why I much prefer JEPQ because of that, right? And so if you're, like I said, if you're someone that wants to sell off a percentage of your shares, it may not be the most ideal because in a bear market, you're going to see the share price go down with the market versus, a high yield savings account or a CD or something. So what does JEPQ replace? For this reason, I believe that JEPQ fits better as a replacement for high yield assets that also carry a correlation to equity markets like jump bonds, MLPs, REITs, and other cover call funds that use different strategies like synthetic options, for example, YieldMax. Since inception, JEPQ has held up to MLPs and outperformed the rest by a wide margin. It also did this with less rolling volatility than many of all but junk bonds. Okay, so what could we pair JEPQ with? In an income portfolio, two things are necessary: capital preservation and high income. This has led many investors in search of diversified portfolios. The standard all bond income portfolio no longer holds up, especially after investors were burned so badly by bonds in 2022 when they fell alongside equities. To this end, JEPQ fills the equity premium role. There are several complementary funds I would add alongside JEPQ, and here's why. So the first one is JEPI, and then the second, so JEPI, it's a little bit less volatile, and then the second one, you got SVOL, the Simplify Volatility Premium ETF that shorts the VIX. I made a video about that one. I'm not personally the biggest fan of that one. Another one is the Roundhill Innovation 100 Zero DTE Cover Call ETF. And another one is an intermediate treasury, like the iShares 7 to 10-year treasury bond ETF, which offers a lower yield and less volatility to smooth out the volatility brought on by JEPQ. Another one is QQQ, could be held alongside JEPQ to increase exposure to the long side and lower overall income in exchange for higher upside. So he's kind of approaching the income side and the growth side by including QQQ, because QQQ could not be further apart from the others that he just mentioned. And then lastly, any stable fixed income fund, especially those that are floating rate. So there are likely a ton more options, and depending on your risk tolerance and goals, there are better options than I presented here. For now, I'm considering JEPQ to pair with my JEPI allocation in a moderate equities portfolio. I'm considering small allocations to both in my income portfolio, but have not decided yet what they will replace. I'm eager to pair them alongside SFAL. Okay, that's fine. So I actually do like the combination of JEPQ and JEPI for, more of a balanced approach. That would be more of a conservative asset allocation, combining it with JEPQ. If you wanted a more aggressive allocation, then JEPQ and QQQ as an example, right? So it just depends on what you're looking to solve for. Do you want more income? Do you want more safety? Do you want less volatility? What are you looking for? And then the risks, the largest risk to JEPQ is the market risk, as it is long the US stock market and specifically the NASDAQ 100 index, which as mentioned before is tech and growth heavy. These companies are often hammered or harmed the most in an economic downturn or a market crash. There's also underperformance risk, and JEPQ has not managed to outperform its underlying index in total return. This fund is meant to be an income fund, and so this underperformance should be expected. It just means that investors should buy into JEPQ with the intention of producing income with limit capital appreciation as opposed to outperforming in total returns. So this is very, very important, guys. He explains this very well. The risk is that you're going to have more market volatility and risk to the downside versus, fixed income, right? And the other risk is you're not going to perform as well in a bull market, right? So that's in a big bear market, it's gonna be painful to a degree, right? If you need to sell your shares, not as much if you're just living off the income. In a bull market, it's gonna be a little painful because the NASDAQ might be up, 30%, but JEPQ may only be up 20%, as an example. So, but if you know your goal and your focus is income, then you're kind of taking the middle ground. And in my opinion, there's nothing wrong with that as long as that is your goal. What you don't want to do is if you're in your 20s and you have a 40-year time horizon, you don't want to invest in a JEPQ for the income and limit your upside in a bull market. You want the full-on growth and volatility of the market in QQQ. So it's also understanding how to invest based off of your investment time horizon. So cover calls by design limit upside. This is evident in JEPQ's inability to climb at the same pace as QQQ. This is not a bad thing, however, but should be noted and is a risk to overall performance in bullish markets. In bearish markets, as evident in the chart above by JEPQ's initial outperformance in the mid to late 2022, JEPQ should outperform as there is less upside to limit and income can buoy the performance. So relative to the underlying index itself, yes, it would outperform in a bear market. And that has to do with the total return because it is generating income. In JEPQ in a flat market can also do very well. However, in a flat market, that probably means that there's not a lot of volatility. So you would assume that the premiums would be lower, right? The income that you would be getting month over month would probably be lower because there's not a lot of volatility, and options are derived from volatility in the market, uncertainty in the market. So the conclusion, ultimately, I believe that JEPQ is a buy even with markets at their highs, assuming you want to hold this for a long time and generate consistent income. JEPQ has proven its ability to do that and its place in an income portfolio. For aggressive income investors, I would recommend limiting exposure to JEPQ to 10% or less, or 15% if split between JEPQ and JEPI. I would weight them 5% to 10% instead of evenly split because I favor JEPI's value-heavy holdings over JEPQ's growth-heavy holdings. And a conservative investor should limit their JEPQ exposure to 5% or less of an income portfolio and consider JEPI as a replacement very heavily due to its lower volatility and relative safety from a valuation perspective compared to the NASDAQ 100. And once again, a really quick reminder, this really comes down to who you are as an investor. If you're a fixed income investor, well then yeah, the conservative approach every day, right? But if you are able to stomach a little bit more volatility in the share price and you don't really have to sell your shares, then it really comes down to that. So it's very important that you're factoring that in. And lastly here, I'm very impressed with JP Morgan for both of these funds and how well JEPQ has performed since inception. It certainly inspires more confidence than I have with other funds that use tricks like synthetic options to try and gain a higher yield. We talked a little bit about that in this video and in previous videos of mine talking about some of these other covered call ETFs. And thanks for reading. So that's the article. Let's take a look at a few comments. So the first comment here, thanks for the write-up, 60% JEPI and 40% JEPQ is how I roll. So if you're allocating to 60% JEPI and 40% JEPQ, they go well together. That means you are saying you want less drawdowns in a bear market, or you want less volatility. You want to see your portfolio value go down less in a bear market. But on the flip side, you are saying as well, I am willing to forego a higher income, potential from the premiums and lower capital appreciation in return. So it really comes down to the question, what do you have to ask yourself? Do I want more growth potential and higher income potential and have the possibility for higher fluctuations, higher highs, lower lows, right? Volatility? Or do I want the steady eddy? Do I want less volatility? Am I willing to accept a lower return, a lower yield? What's important to you? And that's the question that only you can answer. And that's the important thing. Another comment here, nice write-up and nice returns from JEPQ and JEPI. I currently pair it with other covered calls like QDTE, as you mentioned, and AIPI and FEPI, among others, long JEPQ and JEPI. Yeah, since 2020, there have been so many covered call ETFs that have hit the market. It's hard to keep track of them. FEPI, blah, blah, JEPQ, JEPI, JEPY, IQQQ, like SVOL, like there's so many of them. And then don't even get me started on these yield max ETFs. There's so many of them. And I think, I like the, so the way that I would describe JEPI and JEPQ, these are the run-of-the-mill, the basic versions. This is, let me give you a random example of how I look at this. This is Coca-Cola. This is true classic Coca-Cola. This is not your Coca-Cola that you buy at HEB or the grocery store, the knockoff version, right? There's plenty of knockoff versions of Coca-Cola all across the world. When you're buying JEPI and JEPQ, in my opinion, you're getting more of a classic Coca-Cola, okay? And that's how I view JEPI, that's how I view JEPQ, and that's just how I view it. So I hope that helps you to kind of think about it, because the next time you go to the store, go and look at your Shasta Coca-Cola and all these knockoffs. That's essentially what's happening. So there you have it. And then the last comment here, JEPQ sure has a place in mine in my IRA, also holding JEPI and SEHD in much larger amounts, retired income investor. So I love this. I love combining JEPI, JEPQ with SEHD and with DJRO. Because when you're looking at your overall portfolio, if you're a long-term subscriber of mine, you've heard me say many times, look at your weighted average. Look at your weighted average dividend yield and look at your weighted average dividend growth rate. And it's such an easy, simple way to calculate your weighted average when you just have 3 or 4 ETFs like this, or if you have the majority of your wealth, your net worth in these ETFs. It's very easy to calculate it that way. But I like having JEPQ and SEHD. They go so well together because where one lacks, the other picks up the slack. I guess didn't mean to make that rhyme, but it just did. I'm a poet and I didn't even know it. So that's how I view SCHD and JEPQ, and I love combining them together. Okay, and so that's why I have such a large amount of JEPQ for many of the reasons that I discussed. But coming back to what I was saying, the main reason why I like JEPQ so much is I don't have to take on the single stock risk and over allocate to sin stocks. And I can accomplish that with a better sleep well at night approach. Sure, I might have, a drawdown 1 year of 20%. Okay, that's fine. I'm not going to sell my shares. I'm going to live off the income. And guess what? The income will probably go up because the market's going to be very volatile. So that's how I look at this. And so it's maybe something that you may want to consider if you're looking to retire in the near term or if you're already retired. So that's the article. Overall, I give the article an A. I think he touches on a lot of the most essential things that you have to understand when looking at JEPQ. He talked about the ELNs. He talked about the different approaches of how they don't invest all of the, in all of the NASDAQ 100 stocks. He talked a little bit about, some of the risks. And the thing that I like the most is he talked about who should consider an ETF like this. And he breaks it down, he simplifies it very much so where he talks about, are you conservative or are you aggressive? And the way that he defines conservative is very, very conservative, like ultra conservative. If you, comparing that to like fixed income, like that's ultra conservative, right? Because I would classify myself as a conservative investor, right? I'm not investing into speculative growth stocks, unprofitable stocks, stuff like that, right? So it all comes down to the devil's in the detail, depends on how you view yourself as, conservative investor or an aggressive investor or something in between. But all in all, I really like the article. I'm a huge fan of JEPQ, and I haven't made a video on JEPQ in quite a while, so I wanted a little bit of a refresher. I hope that you learned something new, and I'll see everybody in next week's video. Thanks for watching.